Hey guys, Sharon Joy just jumping on here real quick to talk about some basic accounting principles for you. Hey, so in its most basic sense, accounting describes the process of tracking an individual or company's monetary transactions. Accountants record and analyze these transactions to generate an overall picture of their company's employer's financial health. So, what are some basic accounting principles? So, basic accounting concepts used in the business world cover expenses, revenues, assets, and liabilities. These elements are tracked and recorded in documents, including balance sheet, income statement, and cash flows. So, basic accounting concepts are a little bit different than accounting principles. So, accountants frequently use assets, liabilities, and capitals, but it really doesn't describe completely all of the company's holdings and its financial value. So let's talk a little bit more about the 7 basic accounting concepts. So there are many concepts professionals in accounting use to help them provide the best services to their clients, whether professionals or businesses. Some of the most common concepts are, let's start with revenue. So for a business, the total amount of money the company receives for selling services and products is its revenue. This means it's a company's gross income before deducting any expenses. You can do this by adding all of the company's earnings, equity increases, and interest it gains over the reporting period. A company may deduct its tax liabilities or various expenses from this to finally get to its net profit. Expenses are a type of cost a business incurs to generate its revenue. This includes supplies, materials, rent, advertising, and salaries, repairs, taxes. And so here's an example. So a restaurant manager may purchase ingredients that they regularly use from a supplier to operate its business. So the ingredients are its expenses. And when it makes its sales, that's its revenue. To earn an income, a business aims to have its expenses less than its revenue. It's like a budget, right? So you want to make sure when you do a budget that your income is higher than what's going out. And that's basically what the financial statements are showing you and showing you how to make a profit. So let's kind of switch gears now. We're going to move over to assets. Assets are resources a business owns that brings its economic benefits. So these are things like cash, inventories, receivables, prepaids. And so assets are broken into two categories. It's either a current asset or a non-current or long-term asset. So the current asset are resources the business will use within 1 year, such as checks, cash, receivables, anything it can turn around quickly, and make a profit from very quickly within 1 year. A non-current asset or a long-term item is something that benefits a company over more than a year. And this would be like land, buildings, equipment, stock, bonds. So it's things that tend to hold for a very long period of time. So let's move on to liabilities. Liabilities are economic obligations, or basically what a business owes to other organizations, such as lenders, creditors, bankers, and so forth. So like an asset, a liability can also be current or non-current. So current items these are payments that are due within a year. And so these are like accounts payable, short-term loans, installment on debt, and tax obligations. So non-current liability, these are usually payments that are due longer than a year. So these are like mortgages, where you usually have like a 30-year mortgage, or deferred taxes, or things that become due sometime in the future. Now, another concept that a lot of people have a little bit of trouble with is a capital. Capital can be anything that provides value or benefits for a business owner. It could be assets, machinery, property, inventory. Although cash can be a type of capital, capital usually refers to investments that generate wealth for a business. So here are some types of capital. So you can calculate working capital by subtracting current liabilities from current assets. Working capital includes liquid capital or cash, things that can turn very quickly, things that you can get rid of very quickly. And they cover debts. They cover your long-term debts and accounts payable within the time that they're due. Equity. So an equity is the owner's stake or share in the business of any asset they own, meaning that this is the money the shareholders invest in the company. So if a business liquidates its assets or sells them for cash to pay off liabilities or debts, what's left over is the value that the shareholder gets, which is also known as equity. Debt is something that you owe to someone else, right? So businesses can get debt capital through borrowing loans and bonds and from banks, private investors, government organizations, and it can be a sizable amount of money at one time, or it could just be like a line of credit, something that you use only as you need it. So a type of concept that some people kind of don't quite understand is what an account is. An account is a type of transaction, such as a cash or a sale. Businesses record accounts in the general ledger, which is an accounting book that stores and organizes its transactions. Accounts receivable includes money customers owe to a company for goods and services. Accounts payable are the money a business owes to creditors and suppliers for goods and services. So it's just a way of lumping or grouping things together, grouping transactions together. Now, financial statements, a lot of people hear about financial statements, the income statement, the balance sheet, and they're not really sure where all of that fits in. But the financial statements are simply documents that show the transactions of the business. So, for instance, an income statement. An income statement, sometimes referred to as like a profit and loss statement, is basically a document that details the company's financial performance by reporting its revenues and expenses and the difference during a specific period. A balance sheet is a financial document that the company reports its assets and liabilities and equity. So basically that is what's going to be left over, right? Or the types of items that a company can sell to see what's going to be left over at the end of the business. One statement that a lot of people aren't really aware of is the statement of cash flows. So these statements report the amount of cash a business has earned and the amount of cash it's spent during the period. It's just, as the name says, it's just showing how the cash is flowing in and out of a business. So those are some basic accounting concepts that people may kind of hear, but just kind of want to solidify what they actually are. So we'll see you again real soon. Talk to you soon.